So, you just watched silver crash from $121 an ounce to $64 in about a week. 31% in a single day. The second worst trading session in silver's recorded history. And yet, here's the thing nobody on Wall Street wants to talk about: you still can't actually buy the stuff. I'm serious. Go ahead, try to find a silver eagle at your local coin shop right now. I'll wait. Oh, you found one? Great. Now check the premium. What's that? 40% over spot? 50%? Congratulations, you've just discovered the most bizarre contradiction in modern finance: the price of silver is crashing. But only if you don't actually want to own it. Welcome to the greatest magic trick the financial system never wanted you to see. Let me walk you through what just happened this past week, because if you blinked, you missed one of the most revealing moments in precious metals history. And I promise, by the end of this, you're going to understand why silver has quietly become the financial equivalent of trying to grab smoke with your bare hands. So, we start the week at around $85 an ounce, already nursing wounds from that January 30th bloodbath when President Trump nominated Kevin Warsh as the next Fed chair. Markets freaked out, decided this meant tighter money forever, and silver got absolutely demolished, worst day since 1980. But here's where it gets interesting. The CME Group, that's the Chicago Mercantile Exchange, where silver futures trade, they've now raised margin requirements 3 separate times in 2 weeks. For those not fluent in financial jargon, that basically means they're forcing everyone trading silver futures to put up more cash as collateral. Way more cash. Like, $93,000 per contract more cash. Now, why would they do that? Well, officially, it's to manage volatility. But here's the fun part: every time they raise margins, it forces leveraged traders to either pony up more money or sell their positions. And when thousands of contracts get liquidated at once, the price, well, it does what we just saw. It crashes. So, Friday morning, during Asian trading hours when liquidity is already thin, silver flash crashes to $64. Then something magical happens. It rebounds 15% in a matter of hours, closing back around $76 to $79. You know what that tells me? Somebody was buying. Aggressively. Now let's talk about what's happening underneath all this paper chaos, because this is where the story gets absolutely wild. COMEX, that's the commodity exchange in New York where physical silver is supposedly stored. They've got about 400 million ounces of silver in their warehouses. Sounds like a lot, right? Except only about 113 million ounces is actually registered, meaning it's available for delivery. The rest is just sitting there. Spoken for. Encumbered. Whatever you want to call it. But here's the kicker: in January alone, historically a nothing delivery month, traders stood for delivery on 33 to 49 million ounces. That's 7 to 10 times the normal amount. For a minor month. March is a major delivery month. Analysts are estimating potential demand of 70 to 90 million ounces. Against registered inventory of 113 million. Except nobody actually knows how much of that registered inventory is already encumbered from previous delivery obligations. You see where this is going? Meanwhile, the iShares Silver Trust, ticker SLV, the big silver ETF, just had its largest weekly inflow since the Reddit silver squeeze of 2021. 4.7% expansion. While the price was crashing. People were buying the crash so hard that SLV had to go out and acquire 724 tons of physical silver to back those shares. So, let me get this straight: the paper price is collapsing, margin requirements are through the roof, and yet, somebody's hoovering up physical metal like it's going out of style? Oh, and it gets better. Silver lease rates in London just hit 6.3%. For context, that's what it costs to borrow physical silver for 1 month. When was the last time you saw 6% interest rates on a commodity that's supposedly in oversupply? I'll tell you when: never. Because it's not in oversupply. It's in a deficit. It's been in a deficit for 5 consecutive years. The silver market ran a deficit of 149 million ounces in 2024 alone. Over the past 4 years, cumulative deficits total 678 million ounces. That's 10 months of global mine production that just vanished. Into solar panels. Into electric vehicles. Into AI data centers. Into private vaults. China, which controls 60 to 70% of global refined silver supply, just implemented new export restrictions. you now need to produce at least 80 tons annually to get an export license. That eliminated 90% of Chinese silver exporters overnight. Mexico, which produces 23% of the world's silver, is dealing with open pit mining bans, cartel infiltration of logistics, frozen mining concessions, and a president who's decided resource nationalism is back in style. And meanwhile, industrial demand just hit a record 680 million ounces in 2024. Solar panels alone consume 300 million ounces a year. Every electric vehicle uses 67 to 79% more silver than a regular car. Every AI data center needs silver for semiconductors, connectors, and cooling systems. The US Geological Survey just added silver to the critical minerals list. The same list as lithium and rare earths. The Department of Defense is treating this like a national security issue. But sure, yeah, the price crashed from 121 to 64. On paper. In the futures market, where 99% of contracts never result in physical delivery. Where the paper to physical ratio is 6.6 to 1. Where the CME can just change the rules whenever things get spicy. You want to know what the real price of silver is? Go try to buy a monster box of Silver Eagles right now. Check back with me on what you actually paid. Because I guarantee it's not $64 an ounce. This is what I call the unobtainium problem. Silver is simultaneously the most undervalued and the most unavailable asset in the world. They can crush the price on the COMEX all day long. They can raise margins. They can trigger algorithmic selling cascades. They can get Kevin Warsh to scare everyone about tight money. They can't print physical silver. They can't make solar panels work without it. They can't make electric vehicles without it. They can't build AI infrastructure without it. And they definitely can't make 5 years of cumulative deficits magically reappear in warehouse inventories. Here's what I think is happening, and you can decide if I'm crazy. The paper market is a pressure relief valve. When too many people try to access the physical market at once, the futures market gets crushed to shake out the weak hands. Margin hikes force leveraged specs to liquidate. The price plummets. Headlines scream silver crash. And retail investors who were buying at 120 get scared and sell at 70. Meanwhile, the smart money, the people who understand that solar panels and electric vehicles aren't going away, that 5 years of deficits don't just resolve themselves, that China and Mexico aren't magically going to flood the market with new supply, those people are backing up the truck. 724 tons into SLV in 1 week. Record delivery demand in January. Lease rates at 6%. Shanghai trading at a $10 premium to New York. The truth is leaking out around the edges. People are waking up. Not everyone. Not all at once. But slowly, steadily, the realization is spreading. There's paper silver, and there's physical silver, and they're not the same thing. One is infinite and manipulable. The other is finite and disappearing into industrial applications and private vaults at a rate that exceeds new mine supply by about 95 million ounces a year. You can't taper a deficit. You can't print your way out of physics. And you definitely can't convince a solar panel to work with 6% less silver just because the COMEX says so. So, what happens next? Well, we've got a data-heavy week coming up. Jobs report on the 11th. CPI on the 13th. China goes on holiday for Chinese New Year, which means 10 days without the world's largest silver consumer actively trading. March delivery month is coming, and it's going to be fascinating to see if COMEX actually has enough registered inventory to satisfy demand without default or cash settlement. The structural story hasn't changed one bit. 5 years of deficits. Surging industrial demand. Supply constraints in China and Mexico. Critical mineral designation. Silver going into solar and EVs and AI at record rates. What changed was sentiment and leverage. The fundamentals are screaming one thing. The paper price is screaming another. One of them is lying. And my money, literally, is on the one you can actually hold in your hand. If you found this breakdown helpful and you want to stay ahead of the chaos in precious metals, smash that like button and subscribe. We're living through the wildest supply-demand disconnect in modern commodity history, and I'll be here every week breaking down what's really happening beneath the headlines. Thanks for watching. Stay sharp out there. And maybe, just maybe, stack accordingly.